Yeah, interim results just out for the 6 months to September, and another solid 6 months. Total returns for the period 4.2%, which is annualized over 8%, and the strong theme through that has been income. So returns, if you look back over the 4.5 years since IPO, compound 7.3% per annum, and 70% of that comes from income, which is absolutely aligned with the Custodian strategy of targeting regional property for its higher income yielding prospects. Also through the period, we have continued to identify new acquisitions, so acquired £27 million worth of property. But this isn't just a game of gathering assets. We've also sold £15 million worth of property, and that in itself was an interesting experience. We sold into the very, very strong industrial market, selling an industrial property in central London, just off the Old Kent Road, which sold for 58% ahead of valuation. And this was driven both by the extraordinary rental growth that we had just witnessed at a previous rent review, but also the extraordinary strength of demand for industrial property in the capital. And we also sold 2 smaller retail properties that we felt were ex-growth. Since September, we have continued to acquire another £27 million worth of assets, and we saw particularly in the last quarter of the year, almost all participants in the commercial property investment market dumping retail, getting out of retail, not quite at any cost, but certainly at a significant discount to where market pricing had been. And we acquired 2 out-of-town retail warehouse parks, one in Evesham and one in Weymouth, with excellent tenant lineup at prices that were probably 75 to 100 basis points softer than, in terms of an initial yield, than they might have been 6 months prior. And it was comforting to see in the press at the start of this year, Savills Research picking retail and one other as one of their top investment picks for the year. But that was, might fly in the face of people's experience of the market, and indeed people's expectation for the future of retail. But it was a qualified top pick. And the qualification was that those retail properties must be prime and dominant in their catchment area. And when we look at the 2 retail assets that we bought, I think we could certainly comfort ourselves that they were dominant in their catchment area, and we think will perform well. So we continue to invest, and that has taken us to our target level of gearing of 25% at the close of 2018, which leaves us in a strong position with dividend cover at 109% going into what could be a turbulent year. So at the close of the year, with gearing at our target level, we also have the targeted diversification that we expect from our portfolio, with industrial logistics making up the largest component of the portfolio at just shy of 40%, with about a further 20% in out-of-town retail, which is the area of retail that we feel is going to be more robust than the secondary high streets, where I think we will see the most pain in retail. And that diversification is really important to the Custodian strategy, with 155 properties spread nationwide, over 250 tenants, and our largest tenant representing a little over 3% of the total rent roll. This is a very secure platform for the continued dividends that we hope to pay. When we look back over the last 4.5 years, we've seen Custodian REIT grow from immediately pre-IPO a market cap of around 78 million to around 460, give or take, today. And I don't think that period of growth is over yet. And the desire to grow has come from the continued demand from shareholders, as demonstrated by the premium to net asset value that still exists. Happily, we still have potential shareholders who are excited by the Custodian REIT strategy. Interesting to see in the roundup of 2018, those property companies that exceeded the average and those that fell short. The best performers were those with an alternative strategy. Happily, Custodian was one of those top best performing property stocks, and along with others in our direct peer group like Picton. I think it has been understood that strong focus on a diversified regional portfolio is akin to an alternative strategy when you're looking for secure income, which is really what the market is pursuing. So in order to try and meet that investor demand, we're always looking at opportunities for growth. I think right now, today, we are very shortly after the meaningful vote in Parliament. There is a fair degree of speculation as to which way things will go politically. And while that's not having a direct impact on property market performance, what it is doing is putting off decision making. So everyone is watching and waiting. But as the market and the year unfolds, I wouldn't be at all surprised if we see further redemption pressures on the open-ended funds. And sadly, this is an all too common story. Markets turn against property, and the open-ended funds go from being active buyers to quasi-forced sellers. And that's where we expect to see some opportunity as we go through the year. The outlook for the year ahead is perhaps split between the investment market and the occupational market. I think with a degree of certainty, I can predict uncertainty in the investment market. And difficult to know how that's going to play out. But I think the quest for income will remain a central part of investment demand. And property is a very good provider of income. So I think that the property companies with the right strategy will continue to be in demand. And sadly, we've seen the likes of Intu and Hammerson, who are very shopping centre focused, really suffer at the hands of their investors. But I think those with the right strategy will continue to be in demand. And the other side of the outlook is looking at the occupational market, and perhaps that's the one that I focus on more closely. Occupationally, in regional markets, we have had 10 years now of really no meaningful development. That's led to a lack of supply of good quality, modern office and industrial buildings. There has been development in regional markets, but it's tended to focus on the industrial side, on big box logistics units, and in offices in the big 5 cities in prime, large floor plate office buildings. So for workaday property, for your typical regional occupier looking for a mid-sized industrial unit or a sensible office suite in a regional city, those buildings haven't been built. So we've got shortage of supply, high levels of employment, and those two things together are maintaining pressure on rents. And if we see rents grow, we will see potential for further dividend growth. So I think from an occupational perspective, the outlook is rosy in regional markets. The investment market will do what the investment market does, but I think we can operate comfortably within the confines of what it might do by keeping our focus on the income from our portfolio.